If you can't read these 4 reports, your books aren't helping you, they're just existing. And most business owners, they sometimes run 6, 7 figure businesses without even understanding the 4 sheets that determine if their business is going to survive or not. And here's the scary part. Your accountant might be sending you reports every single month, and you either glance at one number or sometimes don't even open them at all. Today, we're talking about the 4 financial reports that every business owner should know in order to make their business grow. Not just the ones that make you feel productive, but the ones that actually give you control. Because once you've heard clean books matter 100 times, the real question becomes, okay, what do clean books actually produce? Most people think that bookkeeping is just about taxes and tax time, or staying compliant, or just keep the IRS off your back. And yes, that is part of it. But that belief is exactly why so many business owners feel blind inside of their own company. Because clean books don't just produce accurate and clean books and clarity of your direction, they actually produce intelligence. Because the business owner who understands these 4 reports is way ahead of the game through pure knowledge. And in this video, I'm going to break down those 4 reports that turn your business from a reactive business to a proactive one. And by the end, you'll realize something that's slightly uncomfortable. If you don't understand these 4 reports, you're not running your business correctly. You're actually just reacting to it. Let's start with the first one that everybody thinks they understand, which is the profit and loss statement. This is the one that most business owners do open and look at, but they most of the time just scroll to the bottom and look at the profit number. And they ask, did we make money or not? And that bottom number usually tells you that. And the business owner's reaction to that is, if they made money, celebration. If they lost money, what's up? What's going on? What's wrong? We got to fix something. Mild panic. But this report isn't just a scoreboard. It's a diagnostic machine. And if you just look at that bottom line, you're missing 90% of what that report is actually saying. So instead of asking, did we make money when you're looking at this report? What percentage went to marketing? Are my costs rising faster than the revenues coming in? And is the margin shrinking or expanding? For example, if your revenue grows 40%, but your expenses grow 50%, you're kind of not getting anywhere. You didn't scale. You stressed your system. Or maybe your revenue didn't improve. It stayed flat, but your margins improved. That means your pricing or your cost structure got stronger, which is a good thing. And that's leverage. This report doesn't just tell you if you made money or not. It tells you how efficient your model is. And here's the uncomfortable truth. You can look wildly profitable here, but still be running out of cash. This is where the next financial statement comes into place. And it's the one that a lot of people overlook. And this one is called the balance sheet. If the first report tells you how you performed, this one tells you what you actually have in the business. Most business owners skip this because it doesn't feel exciting. It doesn't really show how they did last month. It doesn't shout, it doesn't celebrate. It quietly tracks what you own and what you owe and what's left, which means it quietly tells you if your business is getting stronger or weaker. Here's how you read it like an operator. Is cash trending up or down? Are liabilities outweighing assets? Is the equity building over time? And are you taking distributions? The foundation shrinks. If your credit card balances grow every month, that's not growing your business. That's borrowed confidence. And this report is really what a lot of the loan officers are going to be looking at. The underwriters are going to see if your assets are going to be better than your liabilities. If your assets don't outpace your liabilities, it's the vice versa, your liabilities are bigger than your assets, that's a big red flag to a lot of people and who are going to be looking at if they're going to give you a loan or not. So if you want to get a mortgage or a loan or anything, a car loan, then you're going to want to have this sheet as good as possible. Because the first report, the profit and loss, that measures performance. This one measures stability. And that's what a lot of loan officers are going to want. They want to see stability in order to loan money to you, having confidence that they're going to get that money back. But even if your balance sheet and your profit and loss statement looks solid, you can still go broke. And this is where most profitable businesses get blindsided. is with the next report, which is the cash flow statement. This is where businesses that look successful die. There is a massive difference between revenue earned and expenses recorded and actual cash moving into your bank account. And this report tracks one thing and one thing only: reality. Actual cash in and actual cash out. There's no accounting illusion involved with this. Let's say you close a $100,000 contract. It hits your revenue. You look profitable, but the client pays in 60 days. Meanwhile, payroll hits, rent hits, subscriptions hit, taxes hit. Your first report says you're crushing it. Your bank account says, we need to talk. The cash flow report shows if you're generating, your cash flow report shows if your operations generate cash or not. Profit is accounting. Cash is the oxygen for your business. If you don't understand the difference, you're one delayed payment away from a lot of stress. And speaking of delayed payments, let's talk about the one quiet report that exposes operational discipline. And that report is the AR or AP reports, or better known as accounts receivable or accounts payable reports. Nobody really checks this one until something feels tight. These two reports shows something brutally honest: who owes you and who you owe. Accounts receivable is the invoices that haven't been paid yet. You've done the work. They're supposed to pay by now and they haven't. That's the accounts receivable. And that's whenever things really start getting tight, is whenever they haven't paid for so long. Accounts payable is bills that you're supposed to pay. You hired a contractor and you said you'd pay them after the work was done. And during the time of the work, you have that accounts payable. You know you're gonna have to pay him once it's done. And then once it's done, if you don't pay him, you are behind on payments now. How behind just depends. They call it net 30, net 60, net 90, net 120, which is you could pay them in 30 days, 60 days, 90 days, depending on the contract that you guys signed or your invoice that you had the customer sign. This is where the cash flow problems really start to show. If 40% of what you're owed is 60 days or over that, you don't have a revenue problem because you've already made the sales. You've got the revenue, but you haven't collected, so you have a collections problem. And if you're constantly pushing vendor payments past their due dates, you're using them as a bank, which works until your credit terms disappear. Healthy businesses look at these reports and know exactly what they're owed and what they owe, what's coming in, what's going out. If it's supposed to come in, they follow up aggressively. They control the outgoing time and monitor aging every month. Revenue is just theory if you haven't been paid yet. Collections are execution. This report measures your discipline in the business. And when you combine this sheet with all the other four, you stop guessing, you stop reacting, and you start operating with clarity. If you can't read all four of these reports, your books aren't helping you. They're just existing. So in all, business owners think that bookkeeping is just about taxes. They're not. Taxes happen once a year. But business decisions, they happen every single day. The profit and loss shows efficiency. The balance sheet shows strength. Cash flow shows survival. And your A and AP shows discipline. This is why clean books aren't about taxes. They're about control. And if you really want to understand how this connects to your tax bill, you need to watch my last video. And I'll post it right here. Because if your books are messy, you're not just blind operationally. You're probably giving away money. So go watch this next, and I'll see you there.